Start right in. All right, welcome to our supplementary video. We had a excellent webinar on September 9th of 2021 called Buying Rural Farmland 101. And it was designed to introduce beginning farmers who have never bought rural farmland before to the ins and outs of buying and finding rural farmland, because that's a different animal than buying a city lot or a suburban lot. And so we had a realtor, lending specialist, who's Paul Dietmann, who's here with us today, as well as Andy Wiedner from Compeer Financial as well, who is an appraiser. And because we didn't have forever to do the webinar, there was just so much information to cover. We touched on, Paul touched on the difference between consumer loans and commercial loans. And I felt like after I thought about it, it's like, I bet people need a little bit more of a deeper dive into that. And so this supplementary video is designed just to sort of just tackle that topic a little bit more depth. We hope it's going to be helpful to you. And before I introduce Paul or have Paul introduce himself, I'm just going to say I'm Nathan Alberg with the Liberty Prairie Foundation. We have a land access program called Northeast Illinois FarmLink. We are all about connecting landowners and farmers in Northeast Illinois. If you ever have any questions or need any help, please reach out to us. Check us out at illinoisfarmlink.org. So, Paul, thank you so much for joining us. If you don't mind, just giving us a little intro to yourself, that would be awesome.
Sure. Well, I appreciate the opportunity to talk about this topic in a little more depth, Nathan. I'm Paul Dietmann. I'm with Compeer Financial, which is part of the Farm Credit System. So we're a farmer-owned lending cooperative that operates in northern Illinois, most of Wisconsin, the eastern part of Minnesota. My specific role here is I co-lead our emerging markets loan program, which is a loan program for farmers who market their products directly to consumers or are doing some sort of value added. So I work with a lot of small scale vegetable growers and people raising meat and selling direct to consumers and all that sort of stuff.
Got it. And so you serve both Wisconsin and Illinois, is that correct?
Right, and Minnesota too.
Oh, wow. Excellent. So can you just briefly share your email or something so in case people want to reach out to you?
Sure. My email is paul.dietmann and last name is spelled Dietmann. So it's paul.dietmann@compeer.com.
Excellent. All right. So we're going to jump in. So one of the things that struck me during the webinar was when you talked about the difference between consumer loans and commercial loans. And the general guidelines seem to be if the land and the other buildings of a piece of farmland property are worth more than the house, then that would be probably better to get a commercial loan. Can you just say more about that formula or that dividing line between commercial and consumer loans?
Sure. Yeah. A typical home loan, if you're buying a house in a suburb of Chicago, you're going to get a consumer loan. It's a consumer residential mortgage. And about 90% or more than 90% of the consumer mortgages in the country are sold off to Fannie Mae or Freddie Mac. When we get into farm properties, those are commercial loans. And the dividing line, at least for us, is if the value of the land is more than the value of the home, we consider that to be commercial. If the value of the home is more than the value of the land, it's considered consumer. Now, some other lenders have different rules, but most of the rules typically follow the guidelines of Freddie or Fannie because they're the ultimate arbiters. They're the ones who are going to decide whether or not they're going to buy that loan that the bank wants to sell in the secondary market. Typically, if there's any farm buildings on the property, it can't go consumer. It won't go Freddie or Fannie.
Wow.
If there's agricultural land, it won't typically, unless it's a small amount of land, it isn't able to go to Freddie or Fannie. And so then those loans end up being commercial.
Okay. Can you say more about when you say agricultural land, do you mean land that's in the FSA system or sort of registered as agricultural land, or can you explain that a little more?
Yeah, if it's tillable. Yeah. So if it's tillable land and it's in row crop production or even pasture, yeah, typically Freddie and Fannie will say, no, that's not a consumer mortgage. So they won't take it. And that's really what decides a lot of that is whether or not it fits their parameters.
Got it. Okay. So are there ever times where it's gray, where you could get a consumer loan or an ag loan? Like if you had a house and a little bit of land, like, a farmette, 3 or 4 acres. It was been gardened, but it could be tillable. Is there like ever any gray area there?
Oh, sure. Yeah, there can be gray area on that. And some of it is a bit subjective too. A loan officer looks at a property and says, yeah, I think the land is probably going to be worth more than the house. The appraisal may come in and say, no, the house is worth 300,000, the land's worth 200,000. And
Okay.
then it could be a consumer transaction.
Okay. Is there a simple way for someone who's just looking at a property to determine, just like from looking at it, whether the house is worth more than the land and vice versa?
It's not really. Yeah, it's kind of based on just what your experience is or what you think the house might be
Okay.
worth. Um,
Okay.
yeah, so sometimes it can be a bit murky.
Okay. Because I was looking at several counties, their the county GIS system, where you can look at tax records and assessments. And so the assessment obviously is just based on past information, and it's not the same as the market value. Can you use that at all, or is that still kind of not really what you need to look at?
Yeah, the assessments are notorious for not being very accurate, especially if the property hasn't been sold in a long time.
Okay.
Theoretically, the tax assessment is supposed to keep up with market values, but a lot of times they tend to lag the market. Um, so yeah, it's hard to really use the assessment as an approximation of what the land might be worth or what the house might be worth. And here in Wisconsin, we have use value assessment. So the assessment is the tax assessment of agricultural land is based off of its productivity as agricultural land. And
Right.
a lot of that is based off of its corn productivity.
Sure.
So, so the valuation on that might be really low from a tax assessment standpoint, even though the
Yep.
market value is significantly higher.
Okay. All right. So I was thinking about our audience. Our audience includes um, a good number of vegetable farmers who might not need another farm building, but they could. Um, if hypothetically they were just looking at a homestead or just a farm property where they could just grow some vegetables, not at a large scale, um, can they reasonably assume they might be able to get a consumer loan, or is it just safer just to assume that if you want to farm, and especially if you want a farm building, it's just better to just assume you're going to get a commercial loan?
No, they might be able to get a consumer mortgage to purchase the property. Then,
Okay.
if they put up a building, they may have difficulty financing the building. Maybe,
Okay.
maybe not.
Okay.
Um, if they do put up a building and then they go to refinance their mortgage, they may find that all of a sudden they're not eligible for the consumer market anymore.
Okay.
And then they're out shopping for a loan with someone else.
Got it.
Yeah,
Okay.
we run into that every so often.
Got it. Okay. So then let's assume that the person, a farmer that we're talking about, probably assumes that they want tillable land. They probably want some outbuildings, and they're probably looking at a commercial loan. Let's talk about banks versus cooperatives versus what are the different kinds of entities that can generate a commercial loan, and what are the advantages and disadvantages of working with those kinds of different entities?
Yeah, typically it's either commercial banks or community banks, or it's our system, the farm credit system.
Okay.
And there's a farm credit in every part of the country where, we're a network of cooperatives. Um, there's advantages and disadvantages both ways. I'm obviously pretty biased towards our system. Um, we're and mainly because we can provide a long-term fixed interest rate on farm real estate, which a lot
Hmm.
of local banks can't do. They don't have the tools that we have to set those long-term rates. So the difference will really come down to, can you only get a 3-year adjustable rate or a 5-year adjustable rate, or could you do a 30-year fixed rate? And that's really where our system kind of shines, is the ability to set that long-term interest rate up to 30 years.
Okay. So hypothetically, if they didn't choose to go with you, I'm not sure why they wouldn't, but if they didn't choose
Yeah.
to go with you, and they got a 3-year adjustable mortgage or a 5-year, what happens when it gets to the end of that first 3 or 5 years?
At that point, then the interest rate can reset to whatever the current market interest rate is. And there again, there's a little bit of difference between a commercial and a consumer loan. Under a consumer loan, there's a limit on how much that interest rate can rise over that 3 year or 5 year time period. On a commercial loan, there's less regulation, and so there's no limit on what the rate could rise to. If we had a big jump in interest rates, if they went up 4% in the next
Wow.
5 years, the rate is going to reset at that higher interest rate.
Wow. Can you say a little bit more? You said the FSA system. Um, how exactly is it a cooperative? Who actually, if a cooperative is made up of owners, who actually owns the system?
Yeah, in our system, it's the borrowers that own the cooperative. So when I make a loan to someone, they have to purchase a little bit of stock in the co-op, and so
Okay.
they're becoming owners of the co-op in order to take a loan with us. They get that stock refunded when the loan is paid off, so it isn't
Wow.
like they buy it and it disappears. And then
Okay.
we pay a cash dividend every year based on the profits of the co-op because we are a cooperative. So our board of directors, which is mostly made up of farmers, they decide the profits were X, so we're going to declare a
Sure.
dividend and we're going to pay a cash dividend back to our members of so much.
Okay. Um, and is that significant, or could that dividend be significant for someone who's taking a loan out through you?
Yeah, this last year, we just paid our dividend in August of 2021 for 2020's profits. And the dividend ended up being close to 1% of the average principal on a loan. So
Wow.
it's a significant amount of money. I mean, it's a nice check to receive in the middle of summer.
Okay.
Yeah, and it effectively lowers the interest rate by that much.
Okay. And then last thing, I guess, in terms of commercial loan products, other than interest rate and term and that kind of thing, are there any other features that you should be looking at between different possible options?
Yeah, the difference between a 3 year adjustable or a 5 year adjustable and a 30 year fixed rate, the interest rate difference may be 1.5%. It can be a fairly significant spread. So
Wow.
people will look at that 3 or 5 year and say, "Wow, I'd like to have a 1.5% lower interest rate." And the only time I really recommend that is well, two circumstances. One, if you don't think you're going to own the farm for more than maybe 5 to 10 years, if you're planning
Sure.
to maybe sell that farm and upgrade to another farm,
Yep.
or if you're the type of person who, if you have a mortgage, you want to pay it down as quickly as possible. Then
Okay.
there's an advantage going with that short term interest rate. Um,
Okay.
but if you want to keep some more flexibility, if you want to make sure that you've got the cash flow, then usually it makes sense to lock in a long-term rate, especially now because interest rates are at historic lows. So if you can
Yep.
lock in a 30-year fixed rate at in the 4% range, boy, that's 5 years from now, that might look really, really cheap.
Excellent. Okay. And then I know during the webinar you cover this, but what kind of records do people have to provide you when they're applying for a commercial loan?
We want to see a very simple business plan, just 1 to 2 pages, just very rudimentary business
Okay.
plan. We're going to ask for a balance sheet or a personal financial statement, which is a listing of everything you own and everything you owe. And then we'll ask for 3 years of federal tax returns. Um,
Okay.
there's another difference between commercial and consumer. With consumer loans, because a lot of them are being sold off on the secondary market, people have to show employment history, and usually if you've changed jobs within the last 2 years, it makes it really difficult to get a consumer home loan. On the commercial side, it isn't quite like that. We're looking more at what's your historic earning potential. It doesn't really matter if it's been with one employer or two employers, or if
Wow.
some's been from farm income, some's from non-farm income. We also look at a cash flow projection too. So we want to say, okay, you buy the farm, what's it going to look like in 2022? What's it going to look like in 2023, as you ramp up your production?
Got it.
We'll take that into consideration in the underwriting process.
What about someone who, I mean, in the case of someone who just wants to own farmland, but not actually farm it themselves, maybe lease it out, they have to provide those same sort of documents?
Right. Yeah, they do because
Okay.
it's still consumer, or
Okay.
excuse me, commercial purpose. It's if you're renting it out, that's
Sure.
considered a business.
So that would be part of your business plan. I plan to rent it out, and this will generate so much income, and I'm also going to be working a job, and this will generate this much income. Is that
Right.
that kind of thing?
Yeah, exactly. Yeah.
Okay, excellent. So I think we've actually covered quite a bit. Here's a strange question I came up with. Does it matter whether the lending institution that's providing the commercial loan is geographically close or like in a different state? Does proximity matter at all?
It doesn't matter a whole lot on our side. Some borrowers, they want to be able to just drop into the local office and talk to their lender.
Sure,
Others are comfortable, doing a Zoom call or just visiting once a year or,
sure.
that sort of thing. It really depends on the borrower more so than the
Yep.
lending institution. I think my farthest borrower right now, I've got a person out in Western Kansas, and it's someone I
Wow.
met when I taught a webinar. He contacted me afterwards and asked if I could make a loan. And we typically maintain pretty strict territory lines, but we have a process to work with the local association to get permission to jump
Okay.
across the line. And in that case, it was 3 or 4 territory lines that we jumped across. Um, but he was more interested in someone who kind of understood organics and direct to consumer. If he
Got
was
it.
just getting a farm mortgage and he was corn and soybeans, he could go, to his nearest town and get a loan from someone.
Got it. And with commercial loans, what about the sort of down payment? Is there also sort of a requirement about how much you put down? I know with the USDA program, I think you can put down as little as 5%, if I remember right. Is
Right.
that
Yeah. It really depends on the size of the loan and where
okay?
you are in your farming career.
Okay.
So usually the smaller the loan, the smaller the down payment. So as the loan gets larger and larger, typically we are going to ask for a higher down payment. We have different underwriting standards for what we consider to be young, beginning, or small farmers. So if someone fits in any one of those 3 categories, it
Okay.
switches to a little bit easier underwriting standards, especially for
Okay.
beginning farmers. And I think other lenders do the same thing. There's a lot of emphasis right now in trying to help beginning farmers get started, and we realize land
Got it.
values have gone up at an incredible rate, and it just becomes harder and harder for a beginning farmer to get started, especially if you're not from a farm background. You don't come from a farming family, and you don't
Yep.
have that backstop of your parents, three
Yep.
generation farm with a lot of equity that they can step in and help you out with a purchase. And that's where we partner a lot with the USDA Farm Service Agency's Beginning Farmer Down Payment Program, which is the program that you just
Yep.
mentioned, Nathan. It's only requires a 5% down payment on the part of the beginning farmer. FSA will
Yep.
finance 45% of the purchase at 1.5% interest rate, and it's locked
Okay.
for 20 years. And then
Wow.
we finance our part on a 30-year fixed rate.
Nice.
And we can even discount that our interest rate on that 30-year mortgage if we get an FSA guarantee. And under that program, FSA waives the guarantee fee. So I always ask for the guarantee on those because I can knock at least 0.5% off the long-term interest rate with that
Wow.
guarantee, and it doesn't cost the borrower anything.
If someone wasn't using that program and it's like let's say a $400,000 farm, like what kind of down payment would you be looking for, percentage wise,
In
I guess?
Yeah, in our system, under that scenario, if we weren't getting a guarantee, we're probably going to ask for a 15 to 20% down payment, which
Okay.
is lower than typical. I mean, typical would
Yeah.
be 35%. But
Oh,
because
really?
it's a beginning farmer, if it's someone who's been farming for
Oh,
less than 10 years, we can drop to that 15 to 20%. It kind of depends on the,
okay.
credit, underwriting and all that sort of thing. But generally that's where we'd be.
Okay. And again, to qualify as a farmer, they have to have filed Schedule Fs in the past.
Not with us.
Really?
To qualify as a
Wow.
farmer, as long as they have chosen farming as at least a part-time vocation, and they have the ability to produce $500 per year of agricultural income. They just have to have the ability. They don't necessarily have to have a proven history of
Wow.
producing $500 a year. So that's where I'll recommend with a beginning farmer, if well, let's say they're in your incubator program,
Yep.
I would encourage them as soon as they have any agricultural income at all to file a Schedule F, profit or loss from farming, with their federal tax return, because it is establishing them as a farmer. It's showing some history of farm income and farm expenses.
Yep.
Um, it's not as critical for us as it is if you're going to use that FSA beginning farmer program, because they
Okay.
want to see at least 2 years of
Got
farming experience. So
Got it.
it becomes really important if you think at some point you want to become a farmer, more than just on a very small scale, and you think you're
Right.
going to buy some land, you definitely want to be doing that to prepare yourself.
Excellent. Thank you. One other thing that Deanna, the real estate agent, brought up during the webinar was the importance of pre-approval. And we've heard this from some other real estate agents as well. And I know, and can you say more about pre-approval in the commercial loan area? Is that a normal thing? And you've said a little bit about that in the last webinar, but perhaps you could repeat some of that.
Yeah, and there's pre-approval, there's pre-qualification. And
Oh,
pre-approval is saying, okay, if I'm going to do a pre-approval, I'm going to gather all of the stuff that we would gather for a normal loan application. It's going to go
yep,
through underwriting. We're going to pull a credit bureau report. I mean, we're
yep,
basically doing the full underwriting and saying,
yep,
okay, we're going to approve you for a loan of $300,000, and then you
yep.
find the property that fits under that. We don't usually do that because it's our system. We can process loan applications pretty quickly. And so rather than do that, and then you go out and find a farm where you need $400,000 instead of
Sure.
$300,000, then we have to go through the whole process all over again.
Yeah.
It's a little bit easier if we just process it as an approval, not a pre-approval.
Okay.
Um, there's also what's called a pre-qualification. And a lot of times realtors will say, well, I want you to be pre-approved. What they're actually asking for is they want you to be
Oh,
pre-qualified. Pre-qualification is not as rigorous as a pre-approval. So for a pre-qualification, I'm going to ask somebody for their balance sheet. I'm going to get some really basic information about their income.
yeah.
And then I'm going to run through some cash flow ratios. And I'm going to come back and say, based on this information that you gave me, it looks like you should be able to qualify for a loan of up to
Okay.
$400,000.
Got it.
And if they need a letter for a realtor, I can provide a letter like that, but the letter is going to say, based on information that you provided that we haven't verified, we haven't pulled a credit report, we haven't done anything, we haven't gathered tax returns. It appears that you might probably be qualify for this loan.
Do you
Um,
think realtors in general would say that pre-qualifying is sufficient to take you seriously?
yeah, that generally is what they want. They just want to know that you're not somebody who went through bankruptcy last year. You have no ability to ever get a loan, and but you want to go look at this farm, and so let's have the
Okay.
owners move out of the house for a couple hours, and we're going to walk through your stuff. And that's they're so busy right now. Realtors are, just with the market the way it is. They just don't have the time to spend with someone who doesn't really have a prayer of getting
Yep.
the loan to buy the
Yep.
property.
Yep.
I've even run into that recently with bare land, which I'd never run into before. With bare land, typically, if someone wants to look at it, the realtor says, yeah, go ahead,
Right.
go let the
Yeah.
owner know that you're going to be wandering around out there. Go ahead and look at it. But I just ran into that this summer where they wanted a pre-qualification to even show bare land with no buildings, no home, nothing,
Wow.
just bare land.
Wow. Wow. So can you say one other thing when you're looking at people's balance sheets, and at what point do you get worried in terms of, like, you look at how much cash they have in the bank, and if their down payment's going to be, let's say, 25,000, like, what percentage of their total cash do you feel comfortable with them committing to their down payment versus you want to have them to have a sufficient reserve to actually live and use for their farming?
Yeah, you'd think that would be a straight up answer, wouldn't you?
Come on, Paul.
I would say, I want them to have more than zero. Yeah. And unfortunately, I sometimes run into people who have less than zero. They might have $10,000 in the bank, and thinking, well, I saved up 10,000 for my down payment, but then they've got 20,000 of credit card debt, which is a
Oh,
current liability, and so their
sure.
working capital is negative by $10,000. They didn't think of it in those terms. The other situation that we run into is sometimes, and I've got someone I'm working with right now who's kind of in this position. They've actually saved up a nice nest egg. Their working capital is positive, and they said, "Well, we're going to come in with $100,000 down payment." I'm looking at their balance sheet and I'm saying, "Well, you've saved up 25,000. Where's the other 75,000?" And a gift from their parents, who really want to help them out. That's fine. I mean, and that's
What?
great. I mean, it's wonderful, actually. I'm going to need something,
Sure.
just a simple, it could be an email from the parents saying, yeah, I'm committed to giving them $75,000 to put towards the down payment.
Yep. Yep. Got it. Okay. So, but in general, you would probably feel more comfortable if they did have some cash sitting in the bank that wasn't necessary for the down payment.
Yeah, yeah, I'd like to see excess, and our standard is if we'll look at their cash flow projection for 2022. And if they're projecting that they're going to have $100,000 of gross farm income in 2022, I'd like to see a net working capital position of about 15% of that. So I'd want to see about $15,000. Doesn't
Okay.
necessarily have to be cash. It could be market livestock. It could be
Got it.
inventory. Um, that's not a hard and fast rule, though. So if they're short of that, when I'm developing out their cash flow projection, I'm going to say, well, if you're a little short of that 15% benchmark, we're going to
Yep.
take that shortage and we're going to split it over 4 years. And we want to see that you're working towards that over
Okay.
a 4-year time period, and building up that working capital. It isn't, I mean, part of it is a trust and confidence level with us, but it's also just good business. It's putting their farm on a more solid foundation. They get hit with an unexpected setback. They get hit with a drought, and all of a sudden they don't have any produce to take to market. We want them to have something that they can fall back on. You don't want to be cutting that close to the bone.
Definitely. So we're just about to close up. It did take a little longer than I expected. Thank you for being so patient and thorough. Any final advice? Any like a story of of a successful beginning farmer that you think kind of illustrates a lot of the principles that you've been talking about?
Well, I mentioned the folks that are getting the down payment
Yeah.
from their parents. They actually would have been fine without that down payment from their parents. They've been farming for a number of years. They're still within that 10-year time frame, so they qualify for the FSA Beginning Farmer Down Payment Program.
Wow.
They've really done their due diligence. I did a pre-qualification form more than a year ago, and we've
Wow.
updated that periodically. As their financial situation got a little better and a little better. Um, it's to me they're kind of the epitome. They show really good profit on their Schedule F. They're a very small scale operation. They don't have a lot of gross income. They work very hard, but they've really set themselves up, and
Mm.
I have a tremendous amount of confidence in them. They're a great young couple, and I think they're going to do really well.
So just taking from listening to that story, it's not a pain to you if farmers who are thinking about buying a piece of land in a year or two reach out to you and say, "Could I pre-qualify now? Can you look at my financial situation now? Can you give me some advice?" You don't mind consulting with people over time.
Oh, not at all. No, in fact, I like that because they're asking the right question. They're the first time that they call, they're saying, we want to buy a farm. We don't know what we can afford. We have no idea what we can afford. And we don't want to be looking
Right.
at $1 million farms if we can only afford a $400,000 farm. I'd much rather have them come in early and ask me that question and have a chance to kind of work with them and help
Got it.
maybe coach them a bit rather than
Yep.
have them go out and make an offer on that $1 million farm and then I have to say no.
Definitely. Okay, that's great to hear. Excellent. Well, I think this is it. Thank you so much for taking time and again being so helpful. And yeah, it sounds like people can reach out to you, and you'd be happy to help them.
Oh, definitely. Yeah.
Great. Excellent. Thank you. And
Okay. Thank you, Nathan.
that's a wrap.